One of my favorite restaurant stocks, Portillo's, reported its earnings before the market opened on Tuesday. Results weren't phenomenal. Same-store sales were down a little bit in the quarter. That's following actually a really good 2023. So I'm going to dig into the numbers today and see exactly what's going on. This is a company that I think has a lot of growth potential as it increases the footprint that it has around the country. This is primarily a Chicagoland business. That's where they started. That's where the vast majority of the restaurants are. They're moving now more to the Sun Belt. So Texas, Arizona, they have restaurants in Florida. There's a lot of opportunities to expand this business. There's only 85 or 90 restaurants. So they could potentially 5x, maybe even 10x that restaurant base. And each one of these restaurants is really profitable. But the details within the numbers are really important, at least on a quarter-to-quarter basis. So I want to try to put this into some context. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's get right to the earnings presentation because I think that's a good place to start. This is their Q3 performance, and this is the number that you should always look at first when you look at a restaurant's earnings report. What is the same store sales? The reason you want to look at that is typically a restaurant has pretty high fixed costs. So you have to pay rent, you have to pay labor, but then your variable costs are relatively low, meaning your gross margin, the amount you actually spend on food, relatively low compared to sales. So if you're able to increase your sales by 5%, typically your costs overall are not going to go up 5%. That's where you get operating leverage on the business. If your sales are declining, you have negative operating leverage. That's a tough position to be in. Portillo's tries to put this into a little bit of context and say, hey, you know what? Our third quarter 2023 actually saw 3.9% growth. This was negative 0.9%. So the 2-year comparable stack is actually not that bad. That's 2.9%. I still think these aren't great trends for Portillo's, but hopefully this profitability numbers and some of their expansion numbers will put that into a little bit of context. And by the way, their same store sales is not restaurants that have opened recently. I believe they don't include that until a restaurant has been open for 2 years. So these are actually relatively old restaurants. Profitability, $16 million in operating income, $8.8 million in net income, $41.9 million in restaurant level adjusted EBITDA. This is probably a pretty good proxy for how profitable Portillo's business is. This will pull out things like the costs that are associated with building all these new restaurants. That's relatively high cost up front. You have the development costs. So for people who are finding where that next restaurant is going to be, doing the planning, working with regulators, all that kind of stuff that's pre-opening expenses, Portillo's is going to get more efficient up with that over time. So that's why this restaurant level number is a pretty good number to look at for investors. From a development side, we're still seeing this development schedule start to pick up for Portillo's. Last year, most of the restaurants that they opened were late in the year. Management didn't want to do that again this year, but it looks like a lot of things have been pushed back. So they have opened 4 restaurants as of the end of the third quarter of 2024. There was another one that opened there was another one in Richmond, Texas that opened in the past month. And then under construction, they have another 3 restaurants in Texas, another one in Florida, and another one in Illinois. I'm going to go over their earnings release for this one. This is their prior targets, so their prior guidance for all of 2024, and then their current updated guidance. Now expecting 10 units to open up this year and approximately negative 1% same store sales. They expected that to be flat to slightly positive. On the conference call, management talked a lot about the fact that there's basically a price war going on in the fast casual and fast food segment. So that is starting to have an impact on their same store sales. Commodity inflation still expecting to be mid-single digits. This is something that all of these companies are dealing with. Labor inflation, approximately 3%. But because of cost controls, they have been able to maintain pretty good restaurant level EBITDA margins of 23 to 24%, and some of their general and administrative expenses coming in a little bit lower than previously expected. So the bottom line's holding up relatively well. But again, this is a company that's growing its store base and hasn't hit a critical mass in some of their regions. This is one of the things I think that makes it tough to analyze Portillo's today. Very profitable on a per restaurant basis, about $2 million in restaurant level EBITDA for each restaurant that it's building. Those costs are between $5 and $6 million, especially for their new designer restaurants. So the returns on that investment is very, very high. But what they're not getting a return on today is scale in some of their newer regions. So the Dallas area, for example, as they add more restaurants there, they're going to do more advertising there. Well, you do more advertising. If you only have one restaurant, you're going to hope that everyone is going to that same restaurant. If you have 10 or 20 restaurants in the Dallas-Fort Worth area, that's going to give you much more of a return on a per restaurant basis. So these are the things that Portillo's is dealing with as it expands. Not unusual, not unexpected, but something we just need to understand as investors. The other thing that I also want to highlight, because I've mentioned this before on this channel, this is kind of a strange line item for Portillo's. Proceeds from equity offering net of underwriting discounts and then purchase of outstanding equity of Portillo's OpCo units. What in the world is this? This is related to the Class B common stock that Portillo's has. It's owned by Berkshire Partners, not related to Berkshire Hathaway, but Berkshire Partners, which is the previous private equity owner of Portillo's. So they bought the entire company, then eventually brought the company public, said, hey, we're going to keep these Class B shares of stock, and eventually you, Portillo's, which is basically the Class A shares, are going to buy back those shares. That has been happening over the past couple of years. And you can see that this is as of September 29th, 2024 and December 31st, 2023. The number of Class B shares outstanding has fallen from 17.5 million shares to 11.6 million shares. The number of A shares, which is the shares that you and I can buy as public shareholders, has increased from 55.5 million to 62.2 million. So over the next couple of years, you would expect that these additional 11.6 million shares are going to eventually become A shares as Portillo's issues A shares to buy back B shares. It's basically a one-for-one swap, but that's the way that you need to think about it as an investor. And now this is a relatively small ownership stake, so they no longer have a controlling stake in the company. A weird little nuance with Portillo's, but something to be aware of. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So, okay, numbers from Portillo's. Costs are obviously a challenge. So is pricing. So is demand from consumers. We're seeing this across the landscape for restaurant companies. So not a lot of surprising numbers. I wasn't expecting great numbers from Portillo's, but let's just look at the valuation of the company. So if you include all of those shares, A shares and B shares, the market cap of Portillo's is about $1 billion. They have, as we're standing today, just about $300 million worth of debt on the balance sheet. So that's $1.3 billion in enterprise value. If you look at the run rate of adjusted EBITDA, that's a little over $100 million, $105 to $110 million. So that means the enterprise value to adjusted EBITDA is right around 12. That's pretty reasonable for a company that's going to grow its store count to 12 to 15% on an annualized basis. Those should be pretty profitable stores, should be very high return on investment. So there's a lot of work that needs to be done with Portillo's. And if we can get that same store sales number to tick positive, that's really when I think shares could take off. So not a phenomenal quarter, not a terrible quarter. I'm still expecting a lot of good things from Portillo's, but the execution just needs to get a little bit better. This is not one of those high growth, same store sales growth kind of businesses today, but can it get there 2, 3, 4 years from now? We'll see what the numbers look like, but I continue to be bullish on Portillo's. I think it's one of the better opportunities, and that's a combination of the growth opportunity and also the valuation of the company. So that's where I'm looking at both of these things. It's not just about one number or the other. It's about the combination of growth and value. So let me know what you think about Portillo's results. Leave those comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.